Good morning and welcome to the ARMR Insider Morning Call. Thanks for joining me, everybody. As you know, I'm Brett Rosenthal. For those of you who are new to this process, we have a morning call every morning, 8:30, 8:45. And the object is to get ourselves ready for the trading session. So I'm going to just jump right in and share some quick thoughts with you. Number one, risk monitor, green. Normally it turns to yellow today. Let's talk about that. So the ARMR investing way, right, is this three-stage process. We build our whiteboard. That's where we do all of our fundamental research. So we know what stocks we want to buy when the time is right. Then we shift over to algorithms. We use algos, both algos on the big indexes to drive our big risk decisions, and then algos all the way down to day trading. So group algorithms, individual stock algos, day trading algos. So that determines all of our execution. Okay. Then, of course, the third stage is stop losses to protect ourselves from ourselves and from unforeseen events. So risk monitor green. Normally it's a 5-day window. What I like to say is when we get green, we put our capital to work. Let's take a look at what the markets have done since we went risk monitor green. Okay. So there's the green signal right here. Our red signal was right here. So we went to cash here. The market sold off for a few weeks, found support at the uptrend, made a double bottom and a higher low, closed above the high here. And that was our trigger as our algos went positive that day. And then the market's basically gone up every day and had a kind of a sideways move on Friday. All right. So that's a very strong risk monitor green signal. So normally and all the indexes look like that, right? The NASDAQ, the Dow, the small cap index, the value index, the momentum index, the IBD 50, they all look the same. So we have the institutional footprint of big moves of capital back into the market. So I know all the reasons why the market shouldn't go up. The Fed's going to be tapering. China's, in the midst of an implosion. Who knows? I mean, Congress can't get anything right, can't do anything. There's always reasons, but all we care about is the footprint of big institutions. Are they putting capital to work or taking it out? And the reason really behind that thought, that oversimplified thought, first of all, watching CNBC in the morning is a complete waste of time, right? Because they're going to bring on everybody with a different opinion. And by the time you're done watching, you haven't the slightest idea what direction the market's going to go, right? And, they'll tell you they knew it because they had someone on that said it was going to go in that direction. It's a complete waste of time. The ARMR report is about getting rid of that noise and just looking at what drives markets and what makes money. That's it. And what protects capital, number one. So what drives markets are institutions. If we follow the thought that institutions with billions of dollars, okay, are able to gather information faster than you and I can, then the game of trying to get information edge for us is a waste of time, right? We don't have hundreds of millions of dollars to pay people to tell us what's going to happen, but institutions do. Happens all the time, right? Congressmen trading on inside information, sharing that information with hedge funds putting money to work. I mean, that's a fact. Don't hate the player, hate the game if you want, right? That's the way it is. And instead of railing against it, saying it's not fair, we have to find our own way to identify what's happening and take action, right? And it's never going to be us getting the information first because we're not spending hundreds of millions of dollars with influencers to find out. That's just a fact. The market's always been like that. It'll always be like that. The SEC was set up to try to curtail that. It doesn't mean the SEC gets rid of it. It's going to go on all the time. So the ARMR investing way is to recognize that fact and say, all we care about, we don't need to spend hundreds of millions of dollars. All we care about is figuring out what the institutions are doing. When we see them moving in mass into equities, we put capital to work. We don't overthink it. So that's why the risk on green signal is a high probability entry point that the market is going higher. And then eventually what happens is you find out why later. The market puts on another 5 or 10%, and then you find out why, whatever it is. I don't know what the reason will be. It'll be, I don't know, Congress has a kumbaya moment. They all start to agree. Bills get passed. That's good for the economy. That's a shock, right? I don't know. I'm not saying that's going to happen. But I'm just saying you'll find out later. And the hedge funds knew right now. Big institutions knew now because they pay for that information. All right. So we see this move in last week. We put our capital to work. Normally, I shift it to risk monitor yellow. Okay. I'm changing how I do the red, the green, the yellow to be more intuitive. Yellow is going to mean higher risk caution. It's going to be caution, like we all know yellow is. So normally I go, okay, guys, you got 5 days to put money to work, and then we go yellow. So what I'm saying is we still have 5 days to put money to work because you want to get money to work as close to the entry point as possible. Because not all entry points lead to huge gains. Sometimes it's just a small gain. Sometimes we could be going through institutional distribution and we don't know it, right? This is not a 100% crystal ball. So we have to watch how it performs, raise our stops. If it rolls over, get back out. That happens sometimes, okay? But so what we're going to do is say, okay, risk monitor green, we got 5 days to really get our portfolio together. And then we shift into managed success mode, right? As things are working, we lean into the things that are working. We reduce things that aren't working. As the market, as the bull market blossoms, we start to see what's driving it, and we try to focus there and reduce exposure elsewhere. And I'll get to that in a minute. So anyway, going forward, when I say risk monitor yellow now, it's going to be because there's something wrong with the bull run. It's something the reward to risk is starting to skew towards risk instead of reward where it is now. And we'll start doing things like hedging, booking profits, carrying a cash position, things like that. We'll go over when it goes yellow, and it'll make it an easier transition for when we finally get red. It won't be so abrupt. Okay, so that's what I'm doing, a little bit of a change. Looking at the portfolio and ARMR Insiders, you guys can, every day I write all these thoughts into the captain's log. So you can go reference them and see what I'm saying and get an idea of where my head is. So let's just go to a couple of thoughts. The cannabis space, real quick. I want to go over the cannabis space. Okay, we're looking at MSOS. Okay, let's just use that as our guide. Okay, this low right here is the low we're testing. We put some money to work on that day, had a pretty nasty Friday, but stays above the low. If we stay above the low, we stay with the position, and I'm looking, quite frankly, to build the position. And I don't know if this theory that I'm about to share with you is accurate until we see a higher low and maybe a breakout of the downtrend. But this is what I'm trying to capture, okay? Here's CGC, here's Telray. Those are the three names that I'm working with right now, okay? This is my theory here. Nobody cares about them. Nobody likes them. Everyone thinks they're done. Just read Twitter. I mean, all the guys that were real bullish, months ago think that the space is never going to go up again. That's beautiful. That's just, I read all that kind of stuff, quite frankly, on the cryptocurrencies. And what was it, 2018, when they absolutely imploded and went through their massive correction. Now, of course, they're mainstream, right? And everything's up huge. So this is just a cycle that investment processes go through. Unless you're wanting to tell me that cannabis is going to be outlawed. Okay, I think we all agree that's not going to happen, right? So here we are. We've given away all of the gains of the excitement of Democrats and whoever you consider to be bullish towards cannabis names. All that excitement's out of the names now. All I read now is nobody thinks they can go up and there's never going to be legislation and blah, 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 right? Perfect time. The reward to risk is perfect right here. And what I'm expecting now is any government movement on any bill. I don't care if it's cannabis bill. Pass the infrastructure bill. Pass any bill. If there's an announcement that Congress can get anything done, it's bullish for cannabis. You watch, cannabis stocks will start going up if we get any bill passed. Because number one, it'll be like, oh, there's no gridlock. They can actually do things. And number two, whatever gets passed, everything that's waiting to get passed moves up a notch, getting closer to getting passed. And when you've got no expectations and nobody thinks it can happen, small changes can have big effects on the stocks, bring in capital. And so that's what I'm looking for. Now, look, if it takes out the lows last week, I'm gone from these stocks. I'll wait and look for the next opportunity. But I'm just saying, if you see them start creeping up, if you see double bottoms show up, and it happens because you say, hey, looks like Congress passed a bill, you'll know why it's happening, in my personal opinion. All right. So eyes are on that. Second group I have an eye on. I say, shh, don't tell anybody, because nobody likes precious metals. Oh, they can't go up. They're terrible. Bitcoin's replaced gold. Silver's manipulated. It will never go up. Blah, 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 blah. That's exactly the time I want to start owning these things. This is a weekly chart of gold. If you can't see the obvious double bottom there, the obvious high or low there, then you're just, I don't know, you're not looking. I mean, you're just not looking. That's just obvious. So does it go up? I don't know. I can't guarantee it goes up, but the reward to risk is in. And that's perfect setup for precious metals. And that's gold right there. That's a weekly chart of gold. How about silver? These are the Sprott funds, right? Right. There's the double bottom. We bought last week right off the low. That's how you have to buy these precious metal stocks. When they start to go, I'm not chasing them. I'll let everybody else bid up my position. So the only thing I'm thinking of doing now is increasing exposure to this group. So let's talk about that. How am I going to increase exposure? The Snap earnings announcement, while we didn't own Snap, so we didn't lose that money, we owned other positions that were negatively affected by Snap. I've changed the portfolio. You can go look at the portfolio page, look at what I changed on Friday. I'm reducing exposure to technology. I'm reducing exposure to single stock technology. From what I heard on that conference call with Snap, what I hear on the conference call at Honeywell, what I hear at other tech companies that have announced their earnings and missed, and not just tech companies, there is we all knew there was this, it's a funny thing about major events in the market. They're always there. We all see them, and then we dismiss them, and then all of a sudden they matter. That's how the market is. Like, just think of the pandemic last year. Anybody paying attention knew that we had a pandemic going on in January, maybe even December, and then January, and then early February, we knew we had a serious problem. And then all of a sudden, February 24th, the market imploded. Something happens that gets all the lemmings to start jumping off the cliff. I don't know. I don't know what it is, right? We never know. So when I said we don't know, in retrospect, we can point to an event and say, oh, that was it. And it totally changed investor perspective. And, they all went that way. So what I submit to you right now is that Snap call, to me, was the wake-up call that the reward to risk in technology isn't worth it to me right now. It's not worth it to me right now. I can't tell, and I think institutions and analysts are starting to figure out they can't tell at all what the earnings numbers are going to be for a lot of these companies. Snap blew up for two reasons. One, iOS. Okay, that had to do with a mobile-only platform. So Snap was adversely affected in a much greater way by the Apple changes. But those changes really, they wrecked them. So it's going to trickle down into other companies that are dealing with that issue. But on top of that, it was the supply chain issue that was a real problem for them. And not because Snap, it's because it's a bigger issue. It's a problem for Snap because all of their advertisers are having supply chain issues, so they're spending less on advertising because they can't fill orders. That's a major problem. That's a hyperinflation problem. I can't believe I just said that word. Let's don't use hyperinflation, okay? Can we just get to inflation first? Okay. That's an inflation problem. We have a supply chain issue that's not being resolved. You can say to me, well, we knew that for a while now. I know. There's been a supply chain issue and everyone says it's going to be resolved, but now we're starting to get earnings and we're getting panicky CEOs saying that they can't get supplies of important products to fill orders. Snap is interesting because Snap works with a lot of advertisers, a lot of companies, and they're saying all of their companies are having problems. That's not just a Snap problem. So what I want to do is shift my investing to companies that benefit from the supply chain issues and get away from companies that are exposed to it if I can. What companies would I'll give you an example. If you look at Netflix, so some technology companies can work, right? Look at Netflix. Netflix stock is going straight up. One reason why Netflix stock is going straight up is because they don't have any issues with supply chain. It's a subscription service. People are watching TV. They don't have advertisers. They don't have to pay. It doesn't make a difference. It's a subscription service. People pay them to watch videos. This stock is doing this well, not just because, Seinfeld is now on Netflix. It's doing this well because institutions are hiding in companies that aren't exposed to the supply chain problem. Cloud-based companies that aren't reliant on advertisers, but are reliant on a subscription service. Those technology names work, right? But then you look at companies that are reliant on the supply chain or advertising, and the stocks are getting wrecked. That's just one example, okay? So what I intend to do, I want to have a technology allocation. It's going to be less than it was originally, which I thought a week ago I wanted X%. I want less than that. And I want to focus that on the NASDAQ 100. I mean, I don't want to try to pick and choose which company may benefit or not. I mean, obviously, I'd rather own Netflix. The stock's already gone. I'm not going to pay up for it. But I could see myself building my QLD position, having bigger exposure to the whole NASDAQ 100 because we're in a bull market and everything's going to go up. But get out a single stock risk in front of earnings numbers. How do I know what Apple's going to say on earnings? I haven't the slightest idea. They got manufacturing in China. They got supply. I mean, they must have supply chain issues. Then they've got the iOS problem. Who the heck would want to own Apple into earnings? The risk reward is just not worth it. I'd rather own QLD. If Apple has a great quarter, QLD will go up. I'll make some money that day. If Apple gets wrecked, QLD will go down. Hopefully not nearly as much, obviously not nearly as much as Apple itself. Amazon, I have to remove Amazon. I mean, they're all about the supply chain. They're moving goods. They can't get as much goods. They can't move as much. People can't get through the ports in California. It's going to be very hard for them to meet their numbers. But even if they do it, even if they meet the numbers, institutions shoot now and they ask questions later. That reward to risk doesn't make sense, so they exit. Okay? So I'm shifting out of those tech names. I'll have tech exposure in my portfolio, but in an ETF of an entire group so I don't get blown up on one stock. And I'm going to focus on companies that benefit from these problems, which are precious metals or companies that don't have any connection to these problems, like cannabis. I mean, cannabis is already down big and it's got nothing to do with supply chain issues, right? U.S. cannabis, Trulieve grows right here and ships it right here in the state of Florida. They don't have to import it. It doesn't come through a port. You see what I'm saying? And to round it out, my last thought is I want to increase my exposure to financials, right? So we have our large positions on Goldman Sachs and JP Morgan, okay? And I think that in an inflationary environment, the insurance stocks do real well, and they're starting to break out of huge bases, and I need to add this to my portfolio. So there's Travelers coming across the top with a perfect cup and handle breakout, okay? I like HIG because I think someone's going to come take them over. Chubb tried to take them over and it didn't work, but I bet they're going to come back. Chubb looks great. And then CNA is a fan favorite. Perfect cup and handle there. Fan favorite of an analyst that I really respect. So So those are my thoughts for today. When it comes to Tesla and Hertz, that's an interesting story. Where is Tesla going to get the supply to fill that order? That's going to be interesting. Stock's up 4.5 on that news, 4.5%, making its way to 1,000, which is the Gamma location. And when it comes to the FOMC meetings and hawkish Fed speak, what you're starting to see is the more hawkish the Fed speaks, the higher precious metals are going, which is typical. That's usually what happens, because what the market anticipates is that the Fed is behind the inflation curve. And when the Fed starts to admit that there's an inflation problem, they're not even close to tackling it yet. And so that's when you start to see precious metals really do well. So that's how I expect that to affect precious metals. We'll see. We have to watch how they trade, and if they continue to improve, I want to focus on them. And honestly, there's many different ways to do it. I'm most comfortable owning the bullion, so I want to increase my exposure to bullion first. Because when this really gets going, I want to make sure I have the bars in hand. That's the Sprott funds. And when you get, I expect the individual stocks to do well, and I'll probably increase my exposure there too. But even there, I'm focused on the ETFs. I think there could be some real potholes out there in the names of an individual company. You think this is a great idea, and then, there are political issues that get in the way of that investment. So I'm focused on the ETFs, so I get the group move that's coming, in the metals. Couple other thoughts just for fun. I love the Sprott funds, and I'm really interested here. SII. So we added shares of Sprott Investment Management, right? This is an investment firm. This is a financial. So this is the combination of my two favorite themes right now: precious metals and financials. This is a precious metals financial story. Look at that breakout coming here in this thing. Doesn't trade a lot of shares. You got to be careful. Maybe 100,000 shares a day, which is not a lot of money. So that thing can skyrocket, and also it can, implode if there's, no bids all of a sudden. But talk about right in the crosshairs. Sprott's right in the crosshairs. It even gives you a piece of the uranium story. I mean, they're asset gathering. They get, they're asset gatherers is what they are, right? So it's a financial story focused on commodities. Wow, that stock should do well in this environment. So that's something to consider. And I can't find a lot of rare earth stories that I'm willing to buy, but that looks like MP Mineral is about to break out of a major pennant. And you know what happens when this thing gets going. I mean, it rips. So those are a couple of interesting ideas that are on my radar right now. All right. Any questions before I go? Maybe Spotify is a good opportunity. And yes, I am, Chad. I'm live on YouTube right now. I'm sharing this with all YouTube subscribers this morning. Figured we'd give them a live look into what a morning meeting is all about. We do this every morning at 8:30. If you guys have an interest in subscribing, right down here you can see the ARMRreport.com. Go check it out and join Chad and I and all the other ARMR insiders all day on the Slack desk. Right? So we're on the Slack trading desk, sharing ideas all day, sharing my screen, letting you guys see what trades I'm involved in. And ARMR insiders are the army of analysts. We get tons of great ideas from fellow insiders, both from an investing standpoint and a trading standpoint. So feel free to check that out if you have an interest in joining us. Spotify, probably an interesting idea, right? Subscription model. But how much of Spotify's business is based on ad revenue? That's a question we have to answer. See, that's a question, Michael, we got to answer. Is it just subscription, or do they get paid on ads? Is a lot of their business through the iPhone? I don't know. We'll have to think that one through. All of you who are still on DWAC, I'm glad you're enjoying it. Probably the most profitable tweet of my life. last week. Stock was trading at 12, and I put that tweet out as the market opened. Holy smokes. Those of you who've made a fortune, I'm so pleased. I'm so pleased. Stock's up another 20% today. It's a very strange market, though, right? Because there's no real business there yet. It's just Trump putting together some type of social network. So retail investors are putting in market orders. I mean, it's kind of ridiculous. I don't know when it's going to end, but it won't be pretty when it does. We'll see what happens. All right, guys. This has been fun. Michael, thanks. Try to research that a little bit and see how much Spot's revenue comes from advertisers. If it's a pure subscription model, kind of like Netflix, then maybe Spotify is a good idea, a good way to play tech. All right, guys. I'll see you on the live trading desk. It's 9:13. Oh, I got to hop here. I got to get that set up so we're ready to go. We'll start looking at our gamma locations using our spot gamma lines, get ourselves ready for our day trades. Because quite frankly, one of my favorite things to do is day trade these indexes. These trades have been unbelievable. And so I'll be looking for it again. Although I will say that based on spot gamma info, we're not looking for a lot of volatility today. So the only way for me to really put on a day trade is to see movement away from the mean and then trade that mean reversion. That's the kind of market we're in right now. When we're in a positive gamma environment, which we are, what we need is mean reversion. In order to get that, we have to get a movement away from the mean, which I like to call a crazy Ivan, right? So for no apparent reason, the market does a 180, implodes for an hour. Then the news hits the wire of why it imploded. And if it's a hawkish Fed story, you can buy that all day long. That works over and over and over again. Market implodes. Some Fed talking hawkish. It hits the news wire. We get a reversal trigger. We buy the index. The thing rips back towards the VWAP. I mean, it's like clockwork. It's almost unfair. It's like stealing candy from a little baby. I feel bad for the baby. That's what it's been like. So I'm looking for that trade. Now, if the market just kind of opens a little bit and kind of crawls sideways, I don't have a trade there. I will short the market. Made money short last week. But in order to do that, we need to pop off the open, a gap up that extends and then can't get any higher and rolls over. We'll put that short out. One day last week, we were short, and then we were long after the crazy eye when we caught both ends. So I'll be looking to do that on the trading desk again. All right. See you guys on the flip side. Have a great trading day.